Here's the only proof you need that stocks are not less riskier in the long term. I'm just going to share with you. It's crazy how people don't get this. All right, so here we are. Historic. This is from Kitces' article here, kitces.com, from his most recent blog post. Historical stock and bond return ranges. And basically, my man, Jeremy Siegel talks about this in Stocks in the Long Run. And we're going to get into this here in just a second. I just want to point something out here. So you can see on any given year, stocks, high volatility, negative 42%, positive 60%. You can see you're at right there. All right. So the more you go to a 60-40 portfolio, a 40-60 portfolio, bond portfolio, and what you're going to see here is that for stocks, the bottom right there, all right there. So you can see this, the bottom goes from negative 42% for a 1 year period to a positive 5% over a 20-year period. All right. So basically what he's saying is even bonds have less risk in the long run than stocks have. That's what Kitces is saying right here. And Siegel says the same thing. They say, look, if you hold it for 20 years, the worst case scenario is you average 5% a year in stocks. Where bonds, you did even worse than that. Your worst case scenario is you average 2% a year in bonds. All right. So that's what Kitces is saying. And this is what people say, like, look at that risk. It goes down right here, it goes down as the longer you hold it. And right here, I'm going to tell you what Siegel says as well. He goes right here. It is very significant that stocks, in contrast to, this is from the 5th edition, by the way. I think it's a 2011, I believe. It's very significant that stocks, in contrast to bonds or bills, have never delivered to investors a negative real return over periods lasting 17 years or more. And we'll just look at this, for example. You can see right here. Stocks over 17 years have never had a negative real return. Real is with inflation included. It's always beat inflation over 20 years. And Siegel says over 17 years. All right. Let's see. Although it might appear to be riskier to accumulate wealth in stocks rather than in bonds over longer periods of time, for the preservation of purchasing power, adjusted for inflation, precisely the opposite is true. The safest long-term investment has been clearly a diversified portfolio of stocks. All right. There's no doubt that inflation-protected U.S. Treasury bonds protect investors from unexpected inflation, but the yields aren't very high. All right, that 100%. I don't have a problem with that. Here's the thing. Where are you today? Where are you today? Are you here in your 1 year return? Or are you here in your 20-year return? I don't get, maybe I'm not explaining it well. I don't understand why people don't get this. Where are you today? Today's rate of return is in this year. Regardless of what happened the last 20 or 30 years, 15, 20, it doesn't matter. What matters is today and forward. All right? I don't know how else I can explain this. People don't say, hey, Josh, my portfolio is down 40%, right here, 40%, but because I've held it for 20 years, it's not risky at all. No one says that. I talk to people all the time. No one says, well, hey, man, I'm down 40%. I mean, every now and again, I'll get a guy who says, literally, I don't care because I've been just clocking stocks. I believe in stocks. Every now and again, I get that. The vast majority of people don't think like that because it doesn't make sense. The vast majority of people are saying, hey, I'm down 40%. And I say, yeah, but over 20 years, you've never lost more. You've always beaten inflation. Your real return in stocks has always been better than your real return in bonds over 20 years. And people say, but today my bonds are down a highest of negative 16 and my stocks are down 42. You're always right here. This is where we always are. We're never here. The long term never comes. We're always in the short term. Again, I hope you can say to yourself, hey, stocks for the long run, I will probably make more money and more inflation adjusted money too, real return, than bonds. Would probably less risk over the long term. But this is where I am today. Today, I am a short-term investor, especially if I just retired. If I just retired, this 20-year time frame doesn't look nearly as beneficial to me because I'm worried about today. I have $1 million today. Yes, in 20 years, that $1 million, if I leave it all in the S&P 500, will probably give me a higher rate of return with less risk relative to inflation than a bonds. I don't have any qualm with saying that. Can I sleep tonight with a 42% decline? The risk to me personally never goes away. You don't sit there and say, I'm an investor. I've been investing for, I've said this, I'll just keep saying it because I'm not sure I'm explaining this well. I've been invested since 2000. I'm a 25-year investor. The risk doesn't bother me because stocks are the long term. The longer I hold them, the less risky they are. Okay, so now you're down 57% a la 2007, 8, 9. I don't care. How many people say that, especially retirees? None. None say that. They say, I want to avoid this right here. And the way to do that is get a more diversified portfolio of stocks and bonds. Especially if I'm pulling money out of this. Anyway, you can see both people can be right at the same time. If you can hold stocks for the long term, you're probably going to do better and beat inflation. Probably. We don't know the future. Historically, you have 100%. You've reduced your risk in holding stocks for a long period, and you've beaten inflation without question. Better than bonds. No one should really argue that. What I'm trying to say is the factor that long term never shows up. You're always in today. I don't want to hear anyone sit there and say, oh, Trump's ruined the stock market. I said the same guy said, yeah, but I thought you said long-term stocks are better than bonds. Well, they are, but then why do you give a crap today? It doesn't make sense. All you care about is 20 years. Why would you care today? Well, the reason you care today is because 20 years ago, you were here, and now you're still here. That's what I'm trying to say. 20 years ago in 2005, you said, man, by the time 2025 rolls around, stocks will do better than bonds with less risk and relative inflation. Yeah, but now we're in 2025. Now you're looking at 2045. You see how that works? It's relative, kind of like Einstein's fake theory on relativity. It's relative. You're saying, yes, I get it, but now I'm in 2025 and I'm worried about 2025, especially if I recently retired. Hey, I just figured I'd share that with you. God bless. Smash. Love your thoughts.